Hi, today we're going to look at asset finance. So asset finance is one of the main types of financing within the Kenyan market. This involves a transaction whereby a borrower is able to secure funding in form of a loan from a lender, which in most cases is either a bank or a microfinance institution, and then the borrower is able to finance the purchase of an asset, such as a vehicle, machinery, or equipment. This transaction then results in a joint ownership of the asset between the borrower and the lender, and the borrower is tasked to repay back this loan, including interest for a set period of time. My name is Joseph Mungi, and I run a company referred to as Finatrack Global Limited, where we provide security solutions for asset finance corporations. So in the event of asset finance, we mainly provide GPS tracking within the market. The purpose of this video is to inform you as a lender and both as a borrower about the basic dynamics of the market here in Kenya. So the first confusion which usually arises in relation to asset finance is the confusion of interest. So before taking this particular loan, you should have a clear understanding of what's the interest of both the borrower and the lender. So the lender targets a safe borrower whereby they'll be able to issue out this amount of money and earn back an interest on the lent out amount. And on the side of a borrower, the borrower looks for a favorable lender who they'll be able to get financing from and easily acquire an asset which in other circumstances would have taken a longer time for them to purchase or could have been difficult for them to raise the necessary funding. With that in mind, you're therefore tasked with clearly having an overview of the motivations towards asset finance. Then another key insight as a lender, what do you look at from the borrower? So basically, within the credit market, there is what is referred to as the 5 C's of credit. So as a lender, you first look at the character. What's the character of this borrower? Next, you also look at the capacity. Does the borrower have a capacity to repay this loan? Then you also look at the market conditions. So what are the conditions surrounding the particular intended use of this particular asset or this borrower, or also the general market conditions. Then in some special circumstances, you also require collateral. So if this borrower is borrowing this particular amount of money, what collateral are they issuing? So if it's a security which they're buying, if it's an asset which they're buying, let's say it's a vehicle, you take it as a collateral. So that's why you have the joint ownership. And finally, you also look at capital. So for capital, this refers to the amount of money which the borrower is able to put into the asset. So let's say the asset is going for 1 million. In some instances, if the borrower is viewed as a higher risk, they might be required to put in a higher amount in terms of capital investment in the asset, showing their commitment towards purchasing this asset. Then, for you as a lender, how do you look at the ideal borrower? So one of the main factors you look at is the terms and conditions of this particular lender. So first of all, you look at the interest. So there are two main types of interest charged on asset finance. First, we have the flat rate and the reducing balance. The meaning of the flat rate is that the constant interest applies throughout the loan term. So in the event that you're borrowing on a flat rate, you're sure that the interest which you're paying each month is a constant amount towards the whole term period of the loan. But for reducing balance, the more you continue paying, the interest goes on reducing as you go by. So you find during the earlier dates when taking the loan, the interest are higher than the principal amount, which goes towards repaying for the asset. So these two, mainly within the Kenyan market, cause a key difference in terms of if you expect to clear this loan before the ended loan term. In most scenarios, for the flat rate, if you want to clear your loan in between the remainder of the loan term, let's say the loan was for 3 years, you want to clear it after 1 year, you are tasked with paying the remaining 2 years installments at once. Unlike for the reducing balance, at the date on which you want to clear, you clear only the principal, not the interest, which you are yet to accumulate or are yet to reach in terms of dates. So that's a clear distinction which you need to pay keen attention to. And also another important thing, you need to also look at the fine print related to these terms and conditions for each bank. So these terms and conditions govern how the bank is approaching you as the borrower. So these are fine details on their terms on repossession, their terms on any delay, their terms on any penalties. So these are key information which you're supposed to be able to get beforehand, before getting into an agreement with this particular lender. Then another key thing to note, in the event that you've already taken the loan and you have challenges repaying the loan, so there are obvious consequences which take place in such a scenario. So you can be able to avoid this first through the following methods. So first of all, you can approach your bank and try and renegotiate for an adjustment in the terms of the loan. Let's say, for example, you're struggling to repay the loan. You can say, instead of struggling, let's increase the loan term such that you're able to restructure this loan and pay fewer amounts but for a longer period of time. Or you can also be able to negotiate for a moratorium. This is, for this particular period of time, you ask the bank, or you rather request the bank, to not repay the loan due to the market conditions which your business or your personal life you're facing at the moment. Then this is able to result in a recalculation of your monthly repayments once you start repaying this loan. In the event that you fail to reach agreeable terms with the borrower, with the lender has an obligation to foreclose. So the foreclosure process involves repossession of your vehicle. So once they repossess your vehicle, you also need to learn about the consequences which also arise. Once they repossess the vehicle, they won't sell it immediately. So you're given the first priority to clear the loan balance or accrued penalties and also related charges such as nearing fee and the storage fee. And you'll be able to get back your vehicle and continue repaying. But in the event that you also fail to do this, the lender has a right to sell your vehicle off and repay themselves the balance of the loan and return to you what is over and above their own interest and charges from your loan. And in such a scenario, the lender won't have to come back to you in terms of selling this particular vehicle. So once they sell it, if it's a vehicle registered in your name and the bank's name, what will happen is a forced transfer will be initiated and the new buyer will be able to get all the rights towards ownership of your vehicle. So with this at hand, I believe now you have clear information on how to better approach asset finance within the Kenyan market. Once again, my name is Joseph Mugi and I run Finatrack Global Limited, a licensed private security in GPS tracking and smart technology solutions.